All right, pod number 8. I'm outnumbered by suits today. You guys have something serious to talk about, I guess.
I know Craig does.
Well, we changed. It's kind of like the House of Commons is back in order and kids are back in school. So now we get to dress up a little bit more from our summer attire. So the fall season brings on suits and ties, apparently.
You get serious for a few months out of the year. That's good.
Jay, what do you got on the docket for today?
So episode 8 of Wealth Talk, unraveling current events and market trends with Plena Wealth Advisors. As always, I'm joined by Clark Linton here in Vancouver. Got Craig White up in our Kelowna office. And again, our goal of the podcast is to provide a window into our conversations about the markets, the economy, and any other topics that may impact our offering to clients. So we've had a bit of a rocky road here the last couple of months in the Canadian and US markets. Anyone kind of want to walk us through what's been happening?
There's two main issues really going on. I think it's really the as we just talked about, inflation continuing to exist, although it's become under control. Last month here in Canada, we saw things tick up again. So when that does happen, the concern out there is that the central banks, Bank of Canada, Federal Reserve, et cetera, will hike rates again. I think that's the concern that's putting pressure on the market. I also think that, the second thing is the effect of where interest rates are today. We're seeing slowdown in the housing market, housing starts, new home construction. We're seeing some signs of economic weakness as well. Companies starting to revise down some of their earnings projections. We're seeing that with analysts as well, with some companies starting to revise down their outlook. Although consumer spending is still strong, starting to see kind of the big ticket items like automobiles and travel, leisure, starting to slow a little bit, and that spending start to trickle down to kind of more smaller and value items. So I think both those things are weighing on the market over the last couple of months.
Yeah, that's well said. And you've seen a bit of a pivot since, maybe going back to the second quarter when a lot of the bad news that markets were absorbing was essentially seen as good news, because it looked at that point like a lot of the central banks had inflation kind of beaten and the trend was in the right direction. Economic data was still, pretty buoyant and resilient. But as you noted, Clark, you've kind of seen a bit of a shift over the last, month to 2 months. And what you're seeing now is a lot of that bad news being priced in as bad news, which is not such a negative thing. That's a good sign, because, from a price perspective, you get some weakness in markets, but that's when you generally see a pivot point for overall equity markets and fixed income markets, when all the bad news eventually gets priced in. And I think it feels like you're starting to get to that point, because in the last week alone, we've priced in a lot of that threat of the longer or higher rates for longer than I think a lot of people anticipated, 3, 4, 5, 6 months ago. The central banks have come out and said inflation has been stickier, and any sort of rate cut now appears to be pushed off into the back half of 2024, whereas in the beginning of this year there was thoughts that we're going to see rate cuts at the end of this year.
And that's really what, we need to see that bad news start to actually have an impact. The central bankers have been very clear in their desire to have the economy weaken, for demand to weaken, and a correlation to that is going to be unemployment numbers starting to tick higher. So it sounds like we're cheering on a bad economy, but really that's what we need. We need to get this over with. We need to have this fall off in demand to actually happen, which we're seeing in the economic numbers. The market's reflecting that to some degree, and we need that to happen to flush out this last bit of inflation, hopefully, and get on to the next growth cycle.
Yeah, I think one of the big issues here is it's with some of the new communication from central banks, including the Fed. I think it's some uncertainty over whether we actually will have a soft landing, whether we will tip into recession or a harder recession. I think the Fed and other central banks are at risk of overshooting like they normally do. And I think that's what the market's concerned about right now, that, out of the last Fed meeting in the States, the survey amongst the FOMC members, it was a consensus that rates would be above 5% until the end of 2024. And if we're now starting to see the negative effects of rising interest rates, as we talked about, a slowing consumer, slowing housing market, if central banks are now starting to communicate they're going to keep rates at this level for another year and a half, that is significant risk to the economy. They might not just battle inflation, they might actually tip the economy into a recession that even 2 months ago people didn't think existed out there on the horizon.
Well, you look at the two comments that the governing council for the Bank of Canada mentioned a few weeks back. They said the resilience of the economy is one of two things. One is the lagged effect of interest rates impacting the economy, which now you're starting to see that working its way through, or the fact that interest rate policy isn't working and they need to become even more aggressive. I'm in the camp of the former, that we need to see the interest rate cycle work its way through, and you're seeing that within certain pockets of the economy that seem to be more interest rate sensitive, such as housing starts. You're starting to see that, construction, whereas manufacturing is actually quite resilient because they're working through some of the supply disruptions that they've had. But to my point, Clark, I think you bring up a very valid point. Do we think that central banks have lost some of their credibility based off of the way they've acted and reacted over the last couple of years?
I don't think they ever had really like that much credibility. We always know that central banks are going to be late to raise rates and they're going to be late to lower them. That's been their MO forever. Why would it ever change?
I'd agree with that. That's my comment, that they will overshoot as they normally do. I mean, to some degree, that's their job, and their mandate is, a large part of their mandate, the primary part of the mandate is to fight inflation. And they made it clear from day one that they will err on the side of caution. In other words, tip us into some economic weakness if that's what it took to fight inflation. So I'm not sure if losing credibility, I think going back to Jay's comment, did they really ever have that credibility, or did people ever expect them to get it right and not overshoot? I'm not sure if that's the case, but I think it's evident. I think that what they wanted is happening. I mean, you mentioned manufacturing, Craig. I think the last Purchasing Managers Index report came out, and new orders on that side are starting to show some weakness as well. And is this healthy? I'd suggest that it is. It's healthy unless we get into a deeper recession than what people anticipate. That being said, I think, Jay, you brought up a minute ago that, are we starting to get through some of this? Does some of this get priced into the market? Look at the negative returns of the market last year. Look at what we've seen over the last couple months. At some point, as we all know, markets are forward thinking, and smart money starts to make decisions 6 to 9 months before the economy does. And we are starting to see some positive things out there. Valuations have come down. When you see great companies falling 20 to 30%, does that already reflect that we're in recession, or we're going to be in recession? I'd argue that mostly it does at this point. Some of the other things that we discussed over the last week, we're starting to see the IPO market heat up a little bit as well. We saw an acquisition, larger acquisition recently. Some of these things we haven't seen over the last few months. Companies like Salesforce, position we own, after laying off 10% of their workforce, 9 months ago or so, they're now hiring back 3,300 people. I mean, those are all kind of these green shoots in the economy that, maybe we are getting through some of this. And
Facebook also announced some additional hiring after doing some layoffs earlier this year. And not, I think, just to reiterate that point, I mean, the IPOs we saw with ARM Holdings and Instacart were two of the biggest IPOs we've seen in the last couple of years. And
well received.
they were well received initially. I mean, they came out amidst a choppy market, which is always a little bit of a question mark in terms of timing, and they still did fairly well right out of the gate. So big appetite out there to own these good companies, and it shows there is still some resilience in the market despite some volatility. I think the other thing we have to be reflective of is September is always a bad month in the market. It always the last 2 weeks in September, we see increased volatility, we see increased downside. It's not unusual at this point. I think I saw a great tweet. Ryan Dietrich, who's a fantastic follow on X, I guess not Twitter anymore, pointed out that when August and September are down more than 1%, so when each month is down more than 1%, the fourth quarter of that year, 9 for 9 times the market has finished the year higher with an average fourth quarter return of 9.1%. So kind of consistent with what you're saying, Clark, it's like, let's get the bad news out of the way. Let's price in the economic weakness we're going through. Hopefully it's relatively short-lived. And as much as there's seasonality in the last couple of weeks of September and even in August, the best part of the market is typically the fourth quarter and into the first 6 weeks of the new year.
Yeah, I think that's it's a great point, and I'd say that's the positive undertone that we're taking from this here is, again, when bad news is getting priced in as bad news, that's the opportunity for us as portfolio managers to step up to the plate, which for a lot of investors, that's the most challenging thing, is to step up and buy when the headline news is negative, when it doesn't feel like the right opportunity. That's when real money's made. So, and really underneath the surface, you're not seeing any structural issues that's pointing to material breakdown in markets themselves. We talk about credit spreads to get a little bit detailed, but corporate credit is not seeing rates move significantly higher. So in other words, it looks like we just lost Jay. The market's still confident in the overall structure of credit right now. So again, my point being here is this is the opportunity for us with some of the cash that we've raised over the past quarter when valuations were elevated to take some profits and reallocate when prices are under a bit of pressure.
Agreed. So let's be a little bit opportunistic here and look for some good discounts out in the market these days. So one of the articles that's been making the rounds, Financial Times came out with a report on the Canadian economic performance titled "Why Isn't Canada an Economic Giant?" It made some bold statements, but basically just evaluated how Canada's performed recently against developed economies. So mostly using the G7 as the measuring stick to evaluate how we've been doing. By one of the statements made was, by any measure, Canada's geography suggests it could be an economic powerhouse, but few ever talk about it in such terms. By purchasing power parity, its economy is ranked 15th globally by size, behind the likes of Turkey, Italy, and Mexico. The OECD has forecast Canadian per capita gross domestic product growth up to 2060 to be the lowest among advanced nations. So basically suggesting that the Canadian economy has been underperforming where it should be, given its assets, given its size, its educated workforce, many other metrics that would suggest much better economic performance. So what's behind this? What do we attribute this to, and how can we kind of turn the ship around if we had our options open to us?
Well, the question is this something new, or is this something that has been systemic for a number of years in Canada? I'd argue the latter. This is not just the last couple of years. We historically have had very low productivity in Canada relative to the States. I think, our average Canadian worker produces 70% of what an American worker can, as measured under an hour. That's lower than the UK, that's lower than Europe, and that's not a new problem. That has been years in making. If you look back over the last 30 or 40 years, we had a huge manufacturing base in Canada that shrunk considerably in the 90s. We then got lucky with China coming, China's economy starting to boom and the demand for commodities. We had a relatively strong economy from 98 to 2015 when oil peaked there. And I think we got complacent nationally from a lot of perspectives, not investing in new technology, not investing or encouraging infrastructure build or innovation or productivity of our workers. We became very complacent. And so since 2015, throughout COVID and coming out of COVID, it's a continued story of Canada underperforming and not taking advantage of the opportunities that we have. I think the article you mentioned, Jay, it does mention to our weaknesses. It speaks considerably to our opportunities as well. And, politically in Canada, so I joked about we're going to get political on this call, is that, we haven't encouraged that. We seem to be focused on other things here in Canada, as opposed to making us a very competitive country internationally.
I read an interesting report because I knew we were going to touch a little bit on this article. And there's a report written by Deloitte a few years back. So a few years back, I think it was 2021 or 2022, this report. And if you look at Canada, amongst a survey of 500 different companies based on hundreds of different metrics of competitiveness, most businesses, one statistics on the World Bank's ease of doing business ranking, Canada's fallen from 4th position in 2006, so the time frame that you referenced there, Clark, to 22nd in 2018. And this ease of doing business from the outside, from foreign direct investment, they say 2 of the major contributing issues are overregulation and government bureaucracy. And government bureaucracy refers to various regulatory authorities. A lot of companies operate on a municipal, provincial, and federal level. That the lack of communication amongst those 3 levels of government is very broken. And then you throw into the regulatory framework that's been put in place. And, us being in the financial industry, we've seen that over the past, 10, 15 years, certainly since the financial crisis, that regulations at times are a burden to the ability for direct investment or for the consumer to work with, with business themselves. So
I'd add to that as well, inefficient trade between provinces, internal trade barriers, which don't get talked about a lot. I think the Alberta Business Council put out a report saying that, just simply alone interprovincial trade barriers and inefficiencies add approximately a 7% tariff per se on goods in Canada. And, whether it's that or regulation, we are just not competitive.
Yeah, I think it's simple to think about, like, if you're starting a business and you had your choice of where you would incorporate, and you're going to look at Canada, you're going to look at the US, you're going to look at any of the other G7. I mean, it's not obvious that you wouldn't choose Canada, but there's so many strikes against us for mostly the things you mentioned in terms of bureaucracy and regulation for the most part. Taxes are another part where you're going to pay the highest corporate tax rates. Now, on the plus side, we do have abundant energy supplies. We have an educated workforce. We've got all these things working for us. It's not hard to imagine some subtle tweaks or some improvement in how we are operating as an economy that could propel us, as this article kind of suggests we could, to be kind of one of these better performing economies. And it's really, I mean, it's hard to boil everything down to taxes and regulation and really say those are the only 2 levers to pull. But if you could make some improvement on those fronts, if you could, as you mentioned, Clark, earlier, refocus on investment and productivity and shift away from our obsession with the housing market. You think about all the dollars that are tied up in housing and real estate, where we need to continue to develop housing and real estate. I mean, it's also a trade-off in this kind of catch-22 where you've got immigration policy that you need to encourage more housing to be built so that workers can live here and produce a vibrant economy. But then the more immigration you get, the more housing you need. So we've kind of running around chasing our tail a bit. but what do you think would be the low hanging fruit in terms of seeing the next 10 years go kind of Canada's way relative to the other G7 countries?
A couple things, Jay. You talked about immigration a little bit. We've talked about it a fair bit on these pods over the last 3 or 4 months. We are bringing in a lot of people, and when you look at our GDP, it's growing at a few percent. If you trickle that down, though, and you look at how many more workers are needed in our country, and we're bringing them in so that GDP continues to grow. But if you trickle that number down and look at GDP per capita, which is falling, it continues to fall, whereas other countries are increasing. It doesn't matter how many people we bring in. Again, that'll show up in the aggregate number of GDP, but things per person continue to get worse, whereas almost any other country out there in the G7, per capita GDP is increasing because they're focusing on the right things. The second thing I'd say to answer your question is I'm not confident that despite the opportunities that we have, that we will turn it around. I think we've proven that politically there's not an appetite to do it. And, if I go off on a tangent a little bit, and I don't mean to pick on the Liberals, maybe I do, but, I look back at their 2021 platform, and I'm not going to, read their executive summary, but their executive summary had everything for everybody except for the economy, not a word about the economy in their executive summary on what their priorities were. Now, I've got it up here on my screen, their top priorities, and you've got a few pictures, and their 6 priorities did mention the economy, but this is 2 years ago. So finishing the fight against COVID-19, as you mentioned, Jay, a home for everyone, a top priority, better healthcare for everyone, reconciliation, a cleaner, greener future, and then 6, a more resilient economy. If you look into a more resilient economy, how does our government define that? Yeah. $10 a day childcare for to become affordable for families. Bring all businesses along to recovery and support them to hire the help they need. Address underrepresented groups in the workforce to build a more vibrant, diverse workforce. Make sure everyone pays their fair share, including big banks and the wealthiest among us. That's our economic platform.
And how vanilla is that? Every country is going to say we want a resilient economy. That.
Yeah. And, I think what we want more than a resilient economy, and I'm just being skeptical here, we've got a lot to be thankful for in Canada. We've got a, great healthcare system, socialized healthcare access to everybody. For those around the world, it's a desired place to live. We've had a focus on the environment, a great standard of living. And I think that's what we've decided as a country to have, at the expense of a resilient economy and global competitiveness. And I just don't see the appetite for that changing.
Yeah, I think that's the big thing. I mean, there's a trade-off, right? If you're constantly or consistently popping up with 3 or 4 cities across Canada that are ranked very highly on the best places to live, and I think Canadians are quite proud of that. I mean, we love living here for many reasons. Now, the economic performance, there's a lot to be desired there. Can you have both? Is there ultimately a trade-off to achieving a good place to live, but also a successful economy? You'd like to think there's room for both, and there's not necessarily at the expense of your quality of life. You're going to have a vibrant economy, right? And so how do you kind of make those tweaks to attract skilled workers, to attract the businesses that want to incorporate in Canada? I'm a little bit more optimistic. I think that can be done, but it certainly doesn't seem to be a focus of Canada at the current juncture.
I think if we're going to change that, we have to change something big in this country and see what happens over the next few years, because this current status quo is not working, is not encouraging that innovation, is not, decreasing regulation, is simply, in my view, is not doing the right thing to get to where, Jay, you would want to be. I think that we'd be holding our breath expecting that our status quo will encourage that.
And it's both on a domestic and a foreign side as well, right? You look at the U.S., they're they're a strong incubator of startup companies. Silicon Valley has been so popular over the last 20 years. Jay, you mentioned some of the IPOs that we've seen on the New York Stock Exchange more recently. When was the last time we saw a Canadian company celebrate a strong listing? I can't recall off behind, maybe Shopify a few years back, but we just, again, because of regulatory authority and the time lapse to be the incubator of capital and innovation and leverage off of the intelligence of Canadians, it just doesn't make it attractive. And that's why you see companies like countries like the US and even parts of Europe that are moving miles ahead of where we are in Canada.
Well, if you look at Canada relative to the States and some other G7 countries, we're, other than our big banks or say our telcos, both highly regulated industries, we are a nation of a large number of small companies, which is great. We have a lot of entrepreneurs, but those small companies are less likely to be globally competitive. They're less likely to export. They're less likely to have the balance sheet or the financing to invest in their company and encourage innovation. I think that's one of our other issues as well. I mean, point to the last largest or large Canadian company that has emerged as a global competitor. I mean, maybe I could say Shopify. But
Lululemon, there's some examples out there, but yeah, they're few and far between.
Few and far between, yeah.
Yeah, we see this in our business with our cross-border side. You have the outgoing populace of Canada that wants to get a good job and advance in their career, and those people are typically moving south. And then you get people moving north who have come to the end of their career and want a comfortable and safe and good retirement, and they're coming up to Canada. It's like we're becoming a society of retirees, and you get a lot of the feeling of the immigration we're seeing, particularly in Vancouver, where you're getting, satellite families that are coming and bringing their kids to school here while while the parents or one of the parents is working abroad, which has been an issue for a long time. And that's not how you create a vibrant economy where people are dependent on the community and society for things like healthcare and education and that sort of thing, which we do very well. But you also need employment and growth and all of those things to truly create a sustainable. I mean, we're talking sustainable not in the sense of environmental sustainability. We're talking sustainable in the ability to pay our bills, to pay for those things like healthcare and education, which we all covet highly. So it's a tricky one. It's not, there's not an easy solution. But I remain
it all ties into the competitiveness, as Clark mentioned, the strength of our labor force. And, look at what's evolved over the past couple of weeks, and it's been a few months in the making with United Auto Workers down in the US, right? Competition amongst the labor force is fierce.
Ever since Jay mentioned Lululemon, I've just been shaking my head a little bit. I mean, great company, nice yoga pants, but I mean, exporting yoga pants around the world, and they're not manufactured here, they're manufactured somewhere else, I believe. But I mean, is that innovation? Is that global competitiveness? I'd argue not. You look at the companies in the States that, the relatively new companies in AI, the Googles and the Amazons and the Microsofts of the world investing billions in artificial intelligence. You look at space technology with SpaceX. I mean, have you seen the Canadian government trying to encourage those companies like Tesla to build a manufacturing plant here in Canada?
Not even on their radar.
Any of that, in Canada at all. And, yoga pants versus AI. I mean, what's going to make us globally competitive? And
well, we did land that, what is it, the Volkswagen battery plant in Ontario last year. I think that was a small win, but I don't know how many billions of dollars in tax breaks we gave them to do that. But I would argue Lululemon's a pretty good example of an innovative company. I mean, they're a massive global competitor and nipping at the heels of even the Nikes and Adidases of the world. And they employ a lot of people in Vancouver with high-paying jobs. So let's not discount them too much. I mean, I think we need to cheer on those success stories where they.
Okay, well, I'll give you Aritzia as well. Throw Aritzia in there as well. Great public company that's now international.
So Craig, you brought up the United Auto Workers strike, which is, I think, an interesting maybe segue into some of these other issues that the economy is facing right now, where we've now been dealing with the Screen Actors Guild strike now for going on about 9 months or thereabouts, and that seems to be coming to a close here pretty soon. Or they've made some headway on that agreement. The United Auto Workers, we saw UPS have a major strike and labor renegotiations. Kind of one of these effects or side effects of the inflationary period where workers are demanding more pay as they're seeing all of their costs start to escalate. So I wonder, where do we see this coming to an end? It's certainly a cycle where inflation causes employers and employees to renegotiate contracts of wages. That's going to create more inflation as there's now more money going through the system. How do you kind of break the back of this ultimately? And should we be worried about, from a market standpoint, how these publicly traded companies are going to experience the wage increases and the effects to their profitability?
I think it's all part of, this revolutionary change where those that are striking have to adapt to new technology. You mentioned the Writers Guild. If you look at, for 60, 70, 80, 90 years, that was all controlled by Hollywood, right? It was the big companies that controlled the writers, controlled the production, etc. Now, with the threat of technology, with the advancement of the Netflixes, the Apples of the world, the Amazon, they're competing directly with those same companies such as Universal, Viacom, etc. Now you've got AI that's a threat to the writers. The ability to script a movie through GPT. So, this isn't a news story. I think it's this ongoing threat, quote unquote, that some people see of technology. And I think that's part of the conversation with United Auto Workers, is the competition that Tesla has set the stage for with this transition to EV and
a non-unionized workforce.
Non-unionized workforce that I think if you were on 10 years ago, Ford, Stellantis, GM of the world would never have thought Tesla has the market share that it does and have the strength of the workforce relative to where they are today.
Well, yeah, Tesla's total labor costs, I think, come in at around $45 an hour. That's wages and benefits. Whereas the big three in Detroit, I think, average out at about $66. It's a huge difference. And, even if they can, as they get wage concessions with the UAW, I think that came out yesterday, that makes them even less competitive against a Tesla, from a labor cost perspective. So I think those threats are out there. However, going back to the inflation question, I think it's just natural to expect, and we've talked about this, on a recent podcast, that this inflation we're seeing ultimately shows up in wages. And if you have a union who can negotiate with larger companies like that, they're going to gain some concessions, and that's going to get passed along. And when inflation moderates, those wages are not going to come back down. That'll be a permanent increase in costs and permanent elevation in the cost of those outputs that those people produce as their wages stay up. Now, that being said, if you look at the UAW contract that was negotiated and finalized yesterday, I think, and I don't have it here in front of me, but I think they want a 10% wage concession in the first year, which pretty much looks after, the inflation over the last couple of years, but only, I think, 2% and 3% increases in year 2 and 3, I believe. So, is this going to continue, these elevated wage increases? I don't know. I think maybe we're going to see a one-time negotiation and we're back to kind of general 2 to 3% increases every year.
I think it just highlights as well how problematic an inflationary cycle can be, both for the economy and the markets. And hopefully, again, we're kind of closer to the end than the beginning of this inflationary period. But I think my feeling is the longer we see inflation stay high, the more we're going to see these types of disruptive strikes, the more we're going to see, workers looking for more, and rightfully so. it's hard to imagine that any other unionized workforce isn't coming to the table demanding more compensation to deal with cost of living increases.
Well, we saw that here in Canada, right? I think we had what was it, the Public Service Alliance of Canada, 155,000 went on strike earlier this year. You've seen that with the ports here, and it's a trend that's out there, and it's a direct result of inflationary pressures. And you look at the trickle down effect going back to Ford, GM, etc. The trickle down effect now is those companies have to absorb these wage increases, which couple things are the end result of that is those companies' margins get squeezed. They have to improve productivity, circle back to what we've been talking about, or ultimately to maintain their margin, the cost of the end product goes up. So the cost for the three of us to go in to buy our new GM, our new Ford F-150 is only going to be passed down. So I don't know what the end result is. It's probably a combination of that, but that in itself is inflationary as well.
And there you can see why these central bankers are actually looking for some sort of economic disruption, because if this cycle just keeps going, all of a sudden you're getting really sticky inflation, and you're getting more and more strikes, more and more wage increases, more and more price increases, and it just never seems to end. So it almost seems like you have to have this, as we kind of touched on before, economic downturn, the spike in unemployment, just to kind of reset everything and start somewhat fresh.
Now, is Elon Musk, is he the one here having the proverbial last laugh, watching the auto workers battle it out and it's business as usual? And
well, as I mentioned, I think any the salary increases with the UAW, that just plays to his hand. It just makes that wage differential and cost differential of labor at Tesla ages. And I mean, that's a huge advantage, $45 versus $65 an hour in total costs. And Elon would argue that his employees are having more fun, they're in a more innovative entrepreneurial culture. And maybe for some people that works. I think the other thing with Tesla that goes unnoticed a little bit, their compensation model is different. I would argue that most of their employees are probably on an option model as well, where they are getting lower salary, they're getting lower benefits, but their total comp may be higher than some of the big three auto worker or the big three companies in Detroit, their workers in total compensation when you add in the options that they're receiving as well.
Well, whose stock would you rather own over the last 5 years, Ford or Tesla?
Yeah, no, I mean, it's a huge point. I mean, if you're building a new company and you've got a motivated workforce and you're going to say, hey, you're going to get a little bit lower hourly pay, but we're going to compensate you the rest with stock that is going to be much more competitive than the other auto manufacturers in this case, it's a huge opportunity, right? And it fully aligns the workforce with what the company's trying to do. Anything else we can touch on before we wrap up here?
Just speaking of Elon Musk, I've just cracked the new book by Isaac Walterson, right?
Yeah. Oh yeah.
It was released a week or two ago. Biography on Elon Musk. Great read so far. Actually, it does talk in some of the early pages about some of his thinking on compensation as well and incentivizing employees. I read a book that was put out a few years ago on Elon Musk. I found it interesting. This one in spades is far better. I'd encourage everybody to pick up a copy of that.
Yeah, that just got released a couple weeks back, didn't it? Yeah.
Certainly a polarizing guy with some strong opinions and a lot of success under his belt. So yeah, definitely.
Well, it's interesting.
Well, that sounds like you, Jay.
Well, I listened to I watched the recent podcast, and Elon Musk was one of the guests, and he was streamed in. This podcast was filmed or recorded out of LA. And Elon was somewhere on his plane, I don't know, traveling, let's assume across the US. And his link was full HD through his Starlink system. And it was no different than the podcast that we're recording right now for clarity, for any sort of disruption. So, what Elon is doing continues to be disruptive, without a doubt.
The reason for that is because
In a good way, I should say.
when I'm on a plane flying economy in Air Canada and trying to get a Wi-Fi connection, that's what I can do. But he can afford to do a lot better. But no, I saw that as well. That was an amazing, actually really good interview.
All right, well, I think that's a good place to leave it. Hopefully we've planted a few seeds of optimism in the otherwise shaky markets here for the three of us. Episode 8. As always, we appreciate your feedback and encourage you to share these podcasts with your friends and family. And until next time.
Thanks, Jay.
Thank you.